Hello there. Well, there's been a couple of significant events recently which have had a bit of an impact on the investment world in the shape of the UK's budget and the US presidential election. Now, the UK budget, of course, could have some implications for the tax and the financial plans of many of our clients, and we will be in touch in due course with some further communications around that. But today we're just going to talk about the investment impact. So, talking about the budget first, well, there's a couple of things where we did see an impact on markets. The big one was in AIM, the alternative investment market. Now, at the moment, you can invest in certain AIM stocks and get 100% relief from inheritance tax in a thing called business property relief. Now, the speculation was that this was going to be removed in its entirety. In the end, that wasn't the case. The relief was cut from the full 40% being relieved to a 20% relief, which actually was seen as a positive by the markets. The market had been sort of not doing so well over the few months running up to the budget in anticipation. And because the news was less bad than expected, if you like, the market jumped. So our AIM portfolio went up by give or take about 7% just after the budget. So that was a positive. It remains to be seen, of course, the long-term impact. The other impact was on the gilt market. Now, gilts are, of course, government borrowing. And after the budget, the cost of borrowing did increase a little bit, so the yield on the gilts went up. Now, some of that may have been due to the fact that essentially the government is going to be borrowing a bit more money than perhaps had previously been thought. But having said that, you look at bond yields across the globe, in the US and in Europe, they went up at the same time. So it's very difficult to say what was sort of international conditions and what was actually specifically related to the budget. Perhaps a very, very small proportion, maybe a 0.1% increase in the cost of borrowing for the government over 10 years. Maybe that was about down to the budget. That is a world of difference from the mini budget from the Liz Truss era, for example, where we saw a 1% increase. So, you know, there were some small impacts on the markets, on certain parts of the market from the UK budget. It was called a budget for growth, and we didn't see that much in the way of kind of announcements that are going to improve economic growth. There's a little bit in terms of investment in infrastructure, and we've seen some announcements about pension funds, so that's all positive. But we'd like to see a little bit more that hopefully, you know, can help boost the growth as the Labour Party pledged in their manifesto. And if so, that would obviously be good for not just the UK economy, but UK investments. On the other side of the Atlantic, we of course had the US presidential election, and it wasn't probably a surprise to a lot of people that Mr. Trump was re-elected as president. Now, again, these had a couple of impacts on markets. The main one was in the stock market, where US stocks went up quite significantly after the election of Trump. And the reason for that is essentially mainly because he's likely to cut corporation taxes. So the companies will pay less tax on their profits, therefore net profits will be higher, and therefore the share price sort of deservedly went up, rationally went up. Now, this had a bigger impact in smaller companies, and that was really positive in portfolios because smaller companies have been one of the areas that we like in the US, so that was good. The other impact we've seen might be a little bit down to some of these other policies, and we'll remain to see sort of longer term what actually happens. But one of the things he's said he's going to do is he's going to put a tariff on all imports, maybe up to 20% on all imports, and maybe 60% or more on imports from China. And essentially that's a tax on the cost of imports. So it's going to push up the cost of those imports. That could be inflationary. As a result, it might mean that interest rates might stay higher for longer. It might also reduce economic growth. Now, because of those potentially higher interest rates, essentially what we saw is that government bonds in the US, their equivalent of the gilt if you like, also sold off, and the yield went up, similar to what we saw in the UK. The dollar strengthened, and that was good for portfolios, because one of the things we'd done in the run-up to the election was reduce some of our US Treasury, our US government bond exposure, and put it in essentially cash, but cash held in dollars. So that was positive. Longer term, we're just a little bit wary that some of those tariffs and some of those things that he's suggested he's going to do, like the crackdown on immigration, that could have an impact on economic growth. And the IMF has actually suggested it could be perhaps as much as a 1% less growth next year, for example, if he enacts all of the policies he suggests he's going to do. And that's a big if with Donald Trump, of course. So we have to be a little bit wary. If US growth is reduced a little bit, then that might not be so good for the longer term of US companies, and they're growing their profits over the time. And so that just reinforces we just need to be slightly cautious about some of those holdings, but actually things like the smaller companies and things like defined returns based on the US, which we covered in the last edition of the Pulse, we think still at really good value. So hope you found that useful. We'll see you next time.